Hello class, this is a video lecture of chapter 12 of the personal finance text, and the title is Investing. Investing. When you invest, you're transferring capital from to those who need it on the assumption that they will be able to return your capital when you need or want it, and that you will also pay and they will also pay you for its use in the meantime. Sorry, didn't have enough coffee this morning. You may reach this stage earlier or later in your life, but at some point you begin to think beyond your immediate situation and look to increase your real wealth and improve your future financial wealth. Investing is about that future. Some of the learning objectives: identify the features and uses of issuing, owning, and trading bonds. Identify the uses of issuing, owning, and trading stocks. Identify the features and uses of issuing, owning, and trading commodities and derivatives. Identify the features and uses of issuing, owning, and trading mutual funds, including exchange-traded funds and index funds. And describe the reasons for different instruments in different markets. So this is going to be broad, a very broad overview of investments. I don't believe we're going to go that deep into commodities and derivatives or stocks and bonds. That's more, that's actually a little more in line with like what you will learn in a master's degree in finance, which is what I have. But this is basically just gonna be like I said, a comprehensive overview. If you have any questions specific about these, feel free to ask and I'll help you out. Um, okay, investments in markets. Bonds equals debt. Investors are lenders, which can be comprised of individuals, corporations, funds, and governments. Issuers are borrowers, and they can be corporations or governments. Okay, so when it comes to bonds, face value equals the principal. A coupon is the interest, which can be fixed or floating. When we're looking at bonds, you know how with stocks sometimes you hear them saying that they paid a dividend on the stock. Well, in bonds, the dividend is actually the coupon payment. So then the interest payment is a coupon payment. So a coupon is not, when we're talking about bonds, is not like you cutting out a coupon from a magazine or from a newspaper. The coupon is the payment that you get on the bond. Okay, and they can be either fixed or floating. The maturity is the term of the bond. Redemption is the payback term, and callable means that you return the bond. So like when you do a call, you're essentially like returning it back. Stock is when you have share of ownership in a certain corporation or any other entity that has stock out there. And a dividend is a share of the profit. So remember how back here, the coupon payments are interest payments on the bonds. For stocks, they are a dividend or a share of the profit. And I actually used to own a couple stocks myself. Off the top of my head, I had um, Advanced Micro Devices, which is AMD, Stem Cell Pharmaceuticals, which is STEM. Um, what else? I had Intel. So basically, like what I tried to do when I was buying stocks is think of the future. So, like for example, back in 1997, 98, no one really knew that Google was going to be so big or that Apple was going to be so big. So if the people who were investing at that time took a look at the needs of society as a whole, and then recognized that there were some companies that were servicing those needs of society, and those wants of society, then they would be, very, very rich right now if they put their money into the right places. So right now, looking forward, now there's a couple of things that I see that are um, the needs, the aggregate needs of society, the aggregate wants of society. So everybody, we definitely want fast telecommunications because we want our internet speeds to be really, really fast. So anything that can facilitate that, fiber optic cables and any other types of technology that helps facilitate speed of internet is something that I would look into. Um, Another thing is the biomedical arena. We're looking at there's a lot of people who are currently studying cures for diseases, terminal diseases like cancer and AIDS and paralysis. So any companies that help facilitate that is something that I would want to get into. Genetics also, and also microprocessors, advanced micro devices, and Intel. The reason being is because no matter which computer, or Nvidia, because no matter which computer you buy, these companies are all competing for each other, with each other to develop the fastest product. So you know that let's we don't even know what the next Mac is going to look like, but definitely that Mac is going to have one of those three microprocessors, and it's going to be the fastest. So if we know the trend is that they'll continue to develop and develop and develop faster and faster and faster technology. So that's kind of like my strategy, is just looking at the needs of society, and then identifying companies that are taking steps to help supply that need. Commodities are our resources. Futures are exchange traded. Forwards are operatively trading, and then options are exchange traded also. Normally, when we're talking about futures and options, we're talking about futures contracts and stock options. Okay, that's the other bit that's missing here. Okay, so funds are a portfolio of investments. You can have mutual funds, index funds, exchange traded funds, or ETFs, and also hedge funds. So these are all different types of funds that you can look into on your own time. We don't have time in this video to go over all of them. Um, but essentially, like if you have a retirement account, or like a 401k through your employer, normally there's the company that manages that investment. TIAA-CREF, you have VALIC, you have a bunch of other companies that manage that 401k. It's their job to take that money and to invest it into different areas. And if you look at how the investment is being broken down, you'll normally see that mutual funds and index funds are mixed into that total investment. Some key takeaways from bonds is that bonds are a way to raise capital through borrowing used by corporations and governments. So if you look, for example, um, like if you Google whenever you get a chance, municipal bonds, and then a city, like wherever you live, Miramar, Pembroke Pines, or whatever, you may be able to find some government bonds. So basically, these are bonds that the government puts out, municipal governments, in order to raise money for other projects, right? So basically, it's like you giving the city of Pembroke Pines, let's say, a loan of like $1,000, right, to do whatever it is that they want to do, and then in return they're going to give you back your $1,000 plus a little bit extra, and that's called a coupon payment. Okay. Bonds are an investment for the bondholder that creates return through regular fixed or floating interest payments on the debt and the repayment of principal at maturity. So a lot of times entities that would invest in bonds are kind of like corporations, and entities that are larger and have the liquidity to buy a lot of bonds, and some of them have like tax advantages as well. Bonds are traded on bond exchanges, and you need a broker to facilitate the bond purchase. Stocks are a way to raise capital through selling ownership or equity. An investment for shareholders that creates return through the distribution of corporate profits as dividends, or through gains or losses in corporate value. Now, there are some companies that do not pay dividends. That doesn't necessarily mean that the company is financially weak. It could just mean that they're not ready to pay dividends yet. And normally, if you look at like if you look at Apple, for example, and their stocks, you'll see that they have shares outstanding. So it'll give you a breakdown of how much stock is in there. So I haven't had a chance to look at how much the Apple stock is worth right now, but you can see um, the amount of stock, their stock value, by looking at their current stock value and then multiplying that by the shares that they have out there. And that's kind of like how you'll have a better understanding of how Apple raises money through through selling stock. Stocks are traded on stock exchanges through member brokers. You can have, for example, Bank of America has Merrill Lynch, and you can use that as the broker exchange to or yeah, through to purchase stock in whatever company you wish. Um, you also have ING, for example, as another one. So those are just a few off the top of my head that I know that I had. Commodities are natural or cultivated resources. So whenever you hear crude oil or corn or wheat, these are commodities, okay? Natural or cultivated resources. Coffee is another one. They're traded to hedge revenue or production needs or to speculate on the resources' prices. And commodities are traded on commodity exchanges through brokers, just like stocks and just like bonds. Broker, broker, broker. Investment and market takeaways. Derivatives are instruments based on the future and therefore uncertain price of another security, such as a share of stock, a government bond, a currency, or a commodity. So the main thing when you look at the word derivative instruments, we're looking at future and we're looking at uncertainty. So these are two keywords that are very important when it comes to derivatives, because it's a way for you. It's kind of like an insurance if you think about it. It's to protect against uncertainty, and there's many strategies that you can use. Mutual funds are portfolios of investments designed to achieve maximum diversification, and that's the key with mutual funds, max diversification with minimal cost through the economies of scale. An index fund is a mutual fund designed to replicate the performance of an asset class or selection of investments listed on an index. And if you look at your retirement account, you'll see that a lot of times they're divided into index funds, and it'll tell you what the indices represent. An exchange traded fund, or ETF, is a mutual fund whose shares are traded on an exchange, and institutional and individual investors differ in the use of different investment instruments and in using them to create appropriate portfolios, which is a debt collection. Investment planning, learning objectives. Describe the advantages of the investment policy statement as a useful framework for investment planning. Trace the process of defining investor return objectives. Trace the process of defining investor risk tolerance. Identify investor constraints or restrictions on an investment strategy. Investment planning. So we have investment policy statement, which subdivides into risk and return and constraints. Risk and return, we're talking about return objective and also risk tolerance. And these are two factors that are considered in there. And there's actually regulatory agencies such as FINRA, which I actually had a chance to work for a little bit, the Financial Industry Regulatory Authority. Because if you have a certain strategy, for example, as an investor, let's say you specifically want to invest in a conservative portfolio, you want to have mostly bonds and 10% volatile stocks, and you really want that strategy for yourself, and your broker or your investment planner goes and puts it all into an account that's extremely risky and not conservative at all, you have grounds to pursue the investment company or this financial planner and sue them, right? Because you specifically told them that you wanted a certain thing and they turned around and did something else because they felt it was better. So, what FINRA does, if you look it up, FINRA, they facilitate the mediation between the investor and the person managing that investment. So they're kind of like the person that like a marriage and family therapist kind of, but between those two, the relationship between the investor and the investment banker. And so that's just one of the things, one of the examples that I can give, because an investor has an objective when it comes to their return, and they also have a risk tolerance, and the broker has to be respectful of that risk tolerance and that return objective. Okay, so then the return objective is essentially a goal, and risk tolerance is your ability and your willingness to tolerate risk. If you don't have $100,000 to spend in an investment, for forex, for example, I know people have heard of the forex market, which is the foreign exchange market, or the speculative market on the exchange of funds, currencies. Then don't even bother investing in forex, because the minimum investment in forex is $100,000, and that's called a lot. So the minimum investment in forex is one lot, which equals $100,000. So if you don't have $100,000 in your pocket right now, don't bother. Unfortunately, just so I can share with you all, I know that in Broward County, there was a really big case with the FBI on Forex fraud. And this was a group of supposedly investors that would go around, and they would specifically target churches, evangelical churches, because it was easy to, that nobody in that church was likely to know about investment planning or anything like that. And they gave them the anticipation that they were going to have a guaranteed return of like 16 or 17%. Whenever you hear that word guaranteed return, unless it's a bond, it's fraud. Don't get lied to, don't get taken advantage of, okay? There is no such thing ever as guaranteed return except for bonds. Bonds will guarantee you a return if they're government bonds, more than anything, because they're secured and they're protected by the Treasury of the US. Um, Banks are also secured with your deposits. They're FDIC insured, Federal Deposit Insurance Corporation, which means that if the banking system, completely collapses in the US, and we have another huge Great Depression, then that means that the government is going to insure your deposit up to a certain amount. I think it's 150 or 250,000. I don't recall, but that's an insurance that is guaranteed to the banks to secure the depositors. Okay, but going back to risk tolerance, there's no such thing as a guaranteed return when it comes to volatile instruments. Okay, so risk tolerance is your ability to invest and your willingness to invest, which is going to change over time because things happen, to the family and things like that impact your ability. Okay, and your ability is influenced by your asset base, the time horizon, and also your liquidity needs. So if you have, you're not going to put in 100% of your cash into an investment. That's not smart because you might lose it all. Okay, so now we talked about ability, so now willingness is your personality, your experience, and also your knowledge. So if you're the type of person that has the personality that you just, give your money and you trust the investment company, then that's fine. That's part of your personality. If you're aggressive and you're on top of this every single day, then perhaps you may want to go solo for a little bit of it. If you have more experience in it, then you're probably going to do a little bit more research before giving your money up for an investment as opposed to just giving it, right? And then also knowledge. So let's just say that in order to plan for your investment, you got to have the personality, the experience, and the knowledge, which all fall into the willingness that you have to have the risk tolerance and recognize the risk and return for an investment. Okay. If the whole spectrum and the whole world of investment intimidates you and you don't want to know, if that's your personality, you don't want to know about stocks, you're not going to track it, you're not going to research the performance of a company or what they do or anything like that, the best thing that you can do, if you have an employer sponsored 401k or 403b, if you work for a nonprofit company, what you can do is take advantage of their matching. So a lot of companies offer dollar per dollar matching. So basically, what they do is like by default they will take the first like couple percent of what you make, and they'll set it aside into your 401k or your 403b, which is your retirement account. But then they also let you do matching, which means that up to a certain percent of your income you can contribute and they will match it dollar per dollar. So if they take 2% of your income and they allow you to match 6% dollar per dollar, that means that you get 6% plus 6% plus 2%. That's a smart thing to do because it's free money that your company is willing to put up for your retirement plan. And that is more guaranteed than putting your all of your money into a speculative market, which yes can return a lot, but it's not worth the risk if you don't have the asset base, the time horizon, or the liquidity to give up all your cash like that. Okay, so here we have an investment policy statement, which risk and return, and which is comprised of risk and return and constraints. Constraints are comprised of liquidity needs, time horizon, tax obligation, legal requirements, and also unique circumstances. Some key takeaways within investment planning is that the investment policy statement provides a useful framework for investment planning because the process of creating the policy requires thinking through goals and expectations and adjusting those to the possible. Um, the statement gives the investor an active role in investment planning, even if if specific details and implementation are left to a professional investment advisor. The statement is portable so that even if you change advisors, your plans can go with you. The statement is flexible. It can and should be updated at least once per year. Return objectives are defined by the investor's goals, time horizon, and value of the asset base. Risk tolerance is defined by the investor's ability and willingness to assume risk. Comfort with risk taking relates to personality, experience, and knowledge. Constraints or restrictions to an investment strategy are the investor's liquidity needs, time horizon, tax circumstances and obligations, legal restrictions, and unique preferences or circumstances. Social investment and divestment are unique preferences based on beliefs and values about desirable or objectionable industries, products, or companies. Your investment policy statement guides the selection of investments and development of your investment portfolio. Learning objectives, measuring risk and return. Characterize the relationship between risk and return. Describe the differences between actual and expected returns. Explain how actual and expected returns are calculated. Define investment risk and explain how it is measured. Define the different kinds of investment risk. Now, I'm going to take a small pause before going to the next slide and let you know as a BC student, if you are taking advantage of these videos that I'm taking the time to do, that if you look at each one of these learning objectives here, these are going to coincide with the learning objectives when you do the final exam and and the midterm also. So if you can do each one of these things, basically you can answer the questions in the midterm and final. So I applaud you for taking the time for watching these videos because it is the study guide for your final and for your midterm exams for this class. Measuring risk and return. Income plus gain divided by original value equals percentage of the rate of return. Um, Remember, we do parentheses first. Ending value minus original value plus income divided by original value equals a percentage of the rate of return. While information about current and past returns is useful, investment professionals are more concerned with the expected return for the investment, that is, how much it may be expected to earn in the future. For investments with a long history, a strong indicator of future performance may be past performance. If the time period you are looking at is long enough, you can reasonably assume that investment's average return over time is the return you can expect in the next year. Red flag. This is not always true, okay? Let's say that a company has been, I'm just going to make a little fake chart here, okay? Let's say that I have a company and the company is, sorry, my pretty bad line graph here. Let's say that there's data here, blah, blah, and this is time, right? Let's say that I create a company that tries to help find the cure for cancer, right? Okay, this is the start of my company, and the value, the stock value. So performance is up and then it's down and then it's up and then it's down and then it levels and then it goes up and up and up and up. And then it kind of looks right now that my company is doing very good, right? Because it's been going up for a significant amount of time. But let's say here in the year 2019, for example, the government passes a law that says that it is illegal to do research on human subjects, for example. What does that do? It's going to cause the whole company to go bankrupt. Why? Because there is a relationship between what the company is allowed to do and its performance. If you think about it, right? So if there's a if there's like, let's suppose hypothetically speaking that there's only three microprocessing companies in the world: Nvidia, Advanced Micro Devices, and Intel, right? So if there's more competition coming in, aside from those three companies, it's going to impact its value over time because now they're competing for the same market share, those three companies. If you add two more companies, it's five companies now competing for the market share. If those two new companies offer a better product, double the speed, the first three, no matter how the history looked like, is going to be completely nullified. So be very careful about that and take into consideration the external factors that you feel are influencing the stock value because that matters. Returns are the value created by an investment through either income or gains. Returns are also your compensation for investing, for taking on some or all of the risk of the investment, whether it is a corporation, government, parcel of real estate, or work of art. Even if there's no risk, you might be paid for the use of liquidity that you give up to the investment by investing, which is also true in the case of bonds, remember? So as long as it's like a government bond or a EE or a treasury bond, it's guaranteed. So there is no risk. The only thing is that you have to use up your liquidity for a designated amount of time in order to get a guaranteed return. Returns are the benefits from investing, but they must be larger than its cost. There are at least two costs to investing. One, the opportunity cost of giving up cash and giving up all your other uses of that cash until you get it back in the future. And two, the cost of the risk you take, the risk that you won't get it back at all. Investment risk is the idea that an investment will not perform as expected, that its actual return will deviate from the expected return. Volatility is the difference between actual returns and average expected returns. This difference is referred to as the standard deviation. Returns with a large standard deviation, showing the greatest variance from the average, have higher volatility and are the riskier investments. What risks are there? There's economic, industry, company, asset class, and market risks. The economic risks are cyclical, inflation, interest rate, and unemployment. Industry risks are cyclical. They incorporate resource costs and are also regulatory. Remember how I told you the example about the law being passed? This would be an example of that. Risks on a company are financing, efficiency, and competition. Remember I mentioned the example of competitors coming in. There's also asset class risks, risk associated with asset class, which involves market liquidity, boom and bust, inflation, and interest rates. And there's also risks in the market with market liquidity, boom and bust, and regulation also. So if you notice, regulation and competition are repeating risks that come in. So those are all things that you have to keep in mind. Key takeaways of measuring risk and return. There is a direct relationship between risk and return because investors will demand more compensation for sharing more risk, investment risk. Actual return includes any gain or loss of asset value plus any income produced by the asset during a period. Actual return can be calculated using the beginning and ending asset values for the period and any investment income earned during the period. Expected return is the average return the asset has generated based on historical data of actual returns. Investment risk is the possibility that an investment's actual return will not be its expected return. The standard deviation is a statistical measure used to calculate how often and how far the average actual return differs from the expected return. And I underline statistical because that's my statistical data analysis is my area of expertise. So this is a standard deviation is the average, basically like deviation from the average, if that makes any sense. Investment risk is exposure to economic risk, industry risk, company or firm specific risk, and asset class risk or market risk. So let's say, just to give you an example of standard deviation, that this is a plot, right? And then you have many like ticks here. Let's say that this is age here, and then this is the amount of money that you make. And these are all people who are responding to like a survey, right? So it's easy to see that this is an upward trend, right? That the older you are, the more money you make. So let's draw a line here. So this is basically a line that cuts through the average between age and income. The standard deviation is basically the average difference between this point here and the average. So like every one of these points that are kind of like hanging out away from the line is what's considered a deviation from the average. And then there's a formula also to calculate the standard deviation as well. And that's used in investment to calculate volatility, which is the deviation from the mean. So if you have a stock that, that performs like this, for example, then the standard deviation is like how volatile it is, because if this is the average and then let's say that this is actual, then it'll show you how much up or how much down the stock goes on average, and that's an important measure in looking at stock. Diversification. Explain the use of diversification in portfolio strategy. List the steps in creating a portfolio strategy, explaining the importance of each step. Compare and contrast active and passive portfolio strategies. Diversification, return with less risk. Here you have, starting from the bottom, security selection, diversify securities, asset allocation, diversify asset and classes, and then capital allocation, risky versus risk less. So here we have asset allocation and security selection, active and passive. You have for asset allocation, you have market timing, underactive, security selection, market timing. I really don't like this graph. Asset allocation, passive, you have lifestyle investing, and then security selection, index funds. Active and passive, I don't like this graph too much. It doesn't really explain so much. Diversification can decrease portfolio risk through choosing investments with different risk characteristics and exposures. A portfolio strategy involves capital allocation decision, the asset allocation decision, and security selection decisions. Active management is a portfolio strategy, including security selection decisions and/or market timing. Passive management is a portfolio strategy omitting security selection decisions and relying on index funds to represent asset classes while maintaining a long-term asset allocation. And that's basically what was meant in this chart here, but the summary explains it a little better. And this concludes the video for chapter 12. If you have any questions, comments, or concerns, please feel free to email me and I'll be more than happy to assist. Thanks for watching and have a great day.